Hi ladies and gentlemen, welcome to SA Accounting Academy. Here's a short clip on one of our previous webinars. I hope that you really do enjoy it.
Good day and welcome to this webinar. We are looking at Section 29, Income Tax, as per the IFRS for SMEs. Now, I just want to point out that Section 29 has been aligned in full with IAS 12, dealing with income tax per full IFRS, and that means that the principles that we are investigating today actually are fully aligned and therefore agree completely with what is currently being done in full IFRS. The agenda points that I would like to discuss today is I would just like to do a quick introduction to Section 29, Income Tax. Then I would like to investigate the tax bases of assets and liabilities and how we apply the definitions of the tax bases. And then I would like to just also illustrate some exceptions to the calculations of tax bases of assets and liabilities, and then investigate how income taxes should be presented and disclosed in the financial statements. So starting off with the introduction to Section 29, Income Tax, the starting point before one thinks of income tax and specifically deferred tax is that you have to align your thinking with what it really means when you're looking at assets and liabilities in the statement of financial position. When you understand IAS 12 and Section 29 income tax per the IFRS for SMEs, you'll see that it's very important that you focus on assets and liabilities, especially when calculating your deferred tax in the financial statements. So when the question is asked, property, plant and equipment of 250 million rand, what does that really mean? There are a few things that stand out. Firstly, property, plant and equipment will therefore, according to what you see on the statement of financial position, provide an expected minimum of 250 million rand in future economic benefits that can be derived out of the specific classes of underlying property, plant and equipment. All right, so we know that it will not necessarily be exactly 250 million rand, and that obviously is impacted by the measurement model. But one thing is clear, we won't be generating less than 250 million because otherwise our asset would have been impaired. So from that 250 million, we can safely assume that we'll be having future economic benefit inflows of at least 250 million rand. The opposite to that lies in the financial liabilities, where we know that our settlement of our present obligations in future will lead to at least 100 million rand outflow in future economic benefits. Now, why this is important is because both these figures are pre-tax. We need to now go and assess what the tax consequences are of the future economic benefit inflows and also the future economic benefit outflows, obviously represented in our assets and liabilities. So with property, plant and equipment, we should firstly realize that the 250 million rand is measured pre-tax. So we don't deduct the tax consequences from the actual asset. We show these future economic benefit inflows gross. So that means before we've taken any tax consequences into account. The opposite is also true for financial liabilities. We do not take into account any tax savings that may be brought about by the financial liabilities, and therefore the tax consequences have to be reflected separately from our assets and our liabilities. Now, not all assets show, or not all assets have future economic benefit inflows that are taxable. And not all liabilities have future economic benefit outflows that are deductible for tax purposes. So naturally, we will have some assets and liabilities that do not have any future tax consequences, and this will then also be taken into account when calculating our tax. So firstly, remember this, property, plant and equipment, the 250 million is pre-tax. It's also the minimum future economic benefit inflows that we expect to take place. The same for financial liabilities, pre-tax, and the minimum that we expect to settle in future, leading to outflow of benefits in respect of financial liabilities. So now the game that we're playing here is that especially in terms of our deferred tax, and I like to refer to deferred tax as future tax. So especially in respect of our future tax, we need to play the game of estimating a tax calculation. What is the tax calculation going to look like in the future if our existing assets materialize and our existing liabilities get settled in the future? And that brings us to another very important point, and that relates to the measurement of our assets and liabilities. Depending on the subsequent measurement model that has been selected to measure assets and liabilities, that will be the actual future economic benefits that will be subjected to the calculation of future tax. So let me explain. With property, plant and equipment, if we go the safe route and we actually measure property, plant and equipment at the historic carrying amount, that means that could quite be quite far removed from the actual future economic benefits that we expect. So the 250 million, if that is the historic carrying amount, could be far less than what the actual future economic benefits are that we expect out of property, plant and equipment. The point that I'm making here is that when looking at future tax, despite the fact that the fair value of the property, plant and equipment might be 300 or 400 million, instead of 250, the point is we are reflecting 250 million rand on the statement of financial position. And therefore, our tax consequences should relate to the 250 million rand only, and not the potential future economic benefits that have not as yet been recognized in the financial statements of the entity. The same obviously applies to financial liabilities and all other liabilities that we calculate future tax for. So these amounts are pre-tax, and we limit the tax consequences to what we have recognized in the financial statements. And obviously, the measurement model plays a very vital role to determine whether, we actually very close to our expectation of actual future economic benefits, which will more be towards the fair value and the revaluation models, or whether we could potentially be quite far removed from the actual future economic benefits that we expect, which will be the case when we use the historic cost model in respect of our assets and liabilities. So it's very important when calculating especially our future tax that we drill down and think of our assets and liabilities and think to ourselves, what are the future economic benefits? How will these future economic benefits present themselves? When you think of something like inventory, it's very important. I'm trying to illustrate here that it's actually simpler to say with inventory, I can link the future economic benefits to revenue, because when I sell my inventory, that results in revenue being recognized. But when you look at, for example, an administration building, that administration building does not have a direct future economic benefit that is so easily identifiable as the future economic benefit arising from inventory. All right, so we need to then say, is my asset being recovered through use, or is my asset being recovered in another way? Because we need to identify the actual future economic benefits, as we said. And sometimes they are very direct, as with inventory, and other times they are not so directly linked to the underlying resource. For example, as we said, an administration building. So we need to assess our assets and our liabilities and really understand what the future economic benefits are, what the tax consequences are of the future economic benefits.
I hope that you enjoyed that video. For more of our webinar videos, go to www.accountingacademy.co.za. Thank you and have a lovely day.